Imagine running a business, right? And you bring in $13 billion this year.
Which is, I mean, an absolute record-breaking triumph by any traditional metric.
Exactly. But then you look at the books and you realize, wait, we are still financially drowning.
Yeah.
You are spending so much money so quickly that you're facing a historic cash deficit. And, that is not a hypothetical scenario. That is the exact reality inside the most famous artificial intelligence company on Earth right now.
It's a staggering contradiction, honestly. I mean, for all the glossy interfaces we interact with, the seamless essays generated in seconds, the photorealistic videos summoned from thin air.
Right, the magic of it all.
Yeah, the actual business of creating that output is a brutal, chaotic, and just unimaginably expensive reality. The financial engine required to make that magic happen is guzzling capital at a rate we have frankly never seen in the history of Silicon Valley.
And peering under the hood of that specific financial engine is exactly what we're doing today. Welcome to the Deep Dive.
Glad to be here.
If you use these tools, if you invest in tech, or if you're just, trying to understand where the global economy is heading, you really need to hear this. We are digging into a freshly surfaced report published literally today, April 7, 2026.
Fresh off the press.
Exactly.
Yeah.
It pulls together confidential financial documents, internal projections leaked to the Wall Street Journal, and hard data verified by CNBC and The Information.
And our mission today is to decode the completely divergent business strategies of the two most valuable AI startups on the planet.
Right, OpenAI and Anthropic. We're going to look at exactly why these two giants are burning billions, how their paths to profitability are just fundamentally opposed, and what this all means as they hurtle toward potential initial public offerings later this year.
The irony really is thick here. You have companies defining the future of human computing, building the most futuristic technology conceivable, yet
they're trapped by the oldest business problem in existence.
Exactly. They have to figure out how to stop spending more money than they make.
Okay, let's unpack this. Because if a company like OpenAI is bringing in over $13 billion in a single year, how is it mathematically possible to still be in the red?
Right.
Where exactly is the leak in the boat? Lay out the 2025 financials for us, because I really want to understand the sheer scale of the hole they're digging.
Well, so the internal documents show that OpenAI completely crushed its own revenue goals for 2025. I mean, they aimed for $10 billion and generated $13.1 billion.
Wow.
Yeah. And in that same 12-month period, their operating spend was $8 billion.
Wait, okay, hold on. So in that specific snapshot, they're actually up. They brought in $13 billion, they spent $8 billion. I mean, that sounds like a highly profitable year.
On a pure, localized balance sheet for that specific 12 months.
Yeah.
But the tech industry doesn't operate on 12-month snapshots, and neither does AI development.
Right.
When you look at the projected future in this report, the floor just falls out. The documents reveal OpenAI is projecting a cumulative cash burn of $115 billion through 2029.
$115 billion. Let me just translate cumulative cash burn for a second. That means the total amount of actual cash they will consume beyond the revenue they bring in just to stay alive and build their products over the next few years.
Exactly.
That is essentially the amount of outside money they have to just set on fire to bridge the gap between their ambitions and their reality.
Yeah.
But why? Normal software development does not cost $100 billion.
No, not at all.
You hire engineers, you write some code, you rent some server space, and you sell the product.
Yeah.
What physical mechanism requires that much capital?
And see, that is the core misunderstanding most people have about artificial intelligence. AI is not software in the traditional sense. It's heavy infrastructure.
Like industrial scale.
Yes, exactly. When you look at that $115 billion cash burn, you're looking at the monumental capital required to physically build out data centers. We are talking about millions of specialized, incredibly expensive microchips.
Yeah.
We're talking about the land to house the servers, the industrial-scale liquid cooling systems to keep those chips from literally melting.
Oh, wow.
And the sheer megawattage of energy required to run the facilities. OpenAI isn't projecting the cost of paying coders. They are projecting the cost of laying the foundational physical utility layer for the next century of computing.
I mean, it sounds less like building a specialized tech tool and more like trying to privately fund a specialized like national highway system,
Right.
and OpenAI is just trying to buy all the concrete in the world before anyone else can lay down a road.
The concrete metaphor is incredibly apt. And, to buy all that concrete, the internal projections show OpenAI plans to spend roughly $600 billion on computing infrastructure alone through 2030.
600 billion, that's just bonkers.
It is. And because of the sheer mass of that infrastructure build-out, they actually do not expect to break even until 2030. To reach that break-even point, they're bracing for an operating loss of about $74 billion in the year 2028 alone.
A $74 billion loss in a single year. I mean, if you're listening to this, you're probably thinking, there has to be another way. Like someone else must be doing this smarter or cheaper.
Right.
And that actually brings us to the second half of this report. Because when we flip to the data on Anthropic, it feels like we're reading a financial document from an entirely different dimension.
Yeah.
What do their projections look like?
Well, Anthropic is operating on the exact same bleeding-edge technological frontier, but their math tells a completely different story. While OpenAI is preparing for that $74 billion loss in 2028, Anthropic's internal documents project together they will actually break even and reach profitability by that exact same year.
Wait, really? By 2028?
Yes. Their projected cumulative cash burn to reach positive free cash flow, the point where the cash coming in finally exceeds the cash going out, is roughly $22 billion.
Okay, I'm doing the math in my head here. $22 billion to reach profitability versus OpenAI's projected cumulative loss of over $100 billion. Anthropic's total cash burn is roughly 1/14 of what OpenAI expects to lose.
Exactly, 1/14.
But, I mean, a 14-to-1 difference in cash burn doesn't just happen because one company negotiates a slightly better deal on servers, right? Like, it's not a rounding error. That massive of a gap has to be the result of a fundamentally different philosophy about what an AI company is actually supposed to be.
It absolutely is. It basically boils down to who they view as their customer. Anthropic's strategy is meticulously corporate. According to the report, about 80% of Anthropic's revenue comes directly from enterprise clients.
80%.
Yeah. They have built a business model almost entirely around B2B, business-to-business solutions. If a massive multinational bank or an international logistics firm needs a highly secure, controllable AI model integrated directly into their internal workflow,
Anthropic builds the architecture for them.
Exactly.
Here's where it gets really interesting, though. I want to push back on this a little bit. You're saying Anthropic is going to reach profitability by basically ignoring everyday people. But aren't consumers the ones driving all the hype?
Sure, they are.
I mean, it's the viral videos, the kids doing their homework with AI, the everyday chatbots that put this technology on the map. If Anthropic consciously avoids the consumer market, won't they just become completely irrelevant in the public eye?
Well, being relevant in the public eye and being financially viable are two very distinct things in this industry right now.
Okay, fair point.
It comes down to something called unit economics, which is just the direct revenue and cost associated with a single piece of your business. Let's look at how Anthropic makes money. They sell API access.
Right.
That means a corporate client pays Anthropic a specific microfraction of a cent every single time their company pings the AI for a task. The corporation pays for the exact amount of compute they use.
So the math always works out.
Exactly. The unit economics are sound. The cost is passed directly to the client. OpenAI, on the other hand, absorbs the cost of the consumer.
Right, because OpenAI is trying to be everything to everyone. Over the last few years, they launched Sora, their photorealistic video generation tool. They launched Atlas, their web browser. They're building consumer hardware. They're weaving e-commerce directly into ChatGPT.
Yeah, it's a massive spread.
But if millions of people are just, using Sora to make funny little videos, who is paying the electric bill for the servers running those models?
OpenAI is, and the compute required for video generation is orders of magnitude higher than text. Think about the mechanism of how this works.
Okay.
Generating text means predicting the next word in a sequence. It's computationally heavy, but, manageable. Generating video means predicting and rendering millions of individual pixels frame by frame, 60 frames a second, while maintaining physics, lighting, and temporal consistency.
So the load is just massive.
The mathematical load on the data center is astronomical. When millions of consumers do that simultaneously, the infrastructure costs skyrocket far past the flat subscription fees those consumers might be paying.
So to put this in perspective, Anthropic operates like a highly exclusive, high-margin consulting firm. It's quiet, It only deals with major corporations, and the clients cover their own expenses.
Right.
OpenAI, meanwhile, is trying to build the world's biggest, flashiest shopping mall. They're stocking it with video generators, search engines, and chatbots, and letting the public wander around for free or for like a low monthly fee. But it costs a literal fortune just to keep the escalators running and the lights turned on.
That's a great way to put it.
Is that shopping mall strategy actually sustainable, or is OpenAI spreading themselves dangerously thin?
What's fascinating here is we actually have public confirmation from the highest levels of the company that this strategy is actively causing operational friction today. It's not some theoretical 2030 problem.
Really? Today?
Yeah. Just recently, OpenAI's chief financial officer, Sarah Fryer, did a wide-ranging interview with Cathie Wood, the CEO of ARK Invest. During that conversation, Fryer was incredibly candid about the tension between their consumer ambitions and their physical constraints.
What did she say?
She admitted that OpenAI is making some very difficult decisions and intentionally not pursuing certain projects simply because they do not have enough compute power.
Oh, wow. That is wild. I want to make sure I'm fully grasping the severity of that.
Here.
You have a company that brought in $13 billion, the undisputed poster child of the AI revolution, and the person in charge of their finances is publicly admitting they literally have to abandon projects because they can't secure enough physical microchips and electricity to run all of them.
Compute is the ultimate bottleneck. It really is the new oil. I mean, you can have brilliant engineers designing consumer hardware or revolutionary web browsers, but if you don't have the physical chips to process the mathematical models behind them,
The ideas just die on the vine.
exactly. This constraint is the driving mechanism behind OpenAI's projection to spend $600 billion on infrastructure. They're trying to buy their way out of the bottleneck to build so many data centers that they never have to shelve a project again.
But if you're burning through billions of dollars of private venture capital to build those data centers, eventually the well runs dry. Private equity firms have deep pockets, sure, but nobody has $600 billion lying around just for infrastructure.
No, definitely not.
Which means, eventually, you have to go to the public. You have to ask regular investors, mutual funds, and pension managers to foot the bill. And according to this report, that massive public reckoning is coming up fast.
The timeline is absolutely accelerating. The financial data compiled here indicates both OpenAI and Anthropic are racing toward potential initial public offerings in the fourth quarter of 2026.
Wow, so later this year.
Yes. And the private funding rounds leading up to this point have set valuations that are going to severely test the gravity of the global stock market.
Let's get the specific valuations from the report so we know the scale of this impending showdown.
Right.
Because in February, Anthropic raised $30 billion in private funding, which valued the company at $380 billion.
Right.
But then, a month later, in late March, OpenAI closed a round that makes Anthropic's look quaint. They raised $122 billion at an $852 billion valuation.
Which is just staggering.
That is the largest private funding round in the history of Silicon Valley.
Yeah.
If you're an investor looking at late 2026, how do you even process companies of this size hitting the public market simultaneously?
If we connect this to the bigger picture, it creates a massive liquidity vacuum. Bankers are reportedly hoping Anthropic can raise more than $60 billion in its IPO alone.
That's Anthropic.
Right. Now, factor in the broader context of the report. SpaceX has also confidentially filed for an IPO in 2026. Yeah, so the global financial system is going to be asked to fund the most ambitious, hyper-capital-intensive companies and human history companies trying to literally build artificial general intelligence and conquer interplanetary space travel all at the exact same time.
It's a lot of money to ask for at once.
Investors are going to have to make a very hard choice between competing visions of the future.
So what does this all mean? The choice is pretty stark. If Anthropic knocks on an investor's door, their pitch is super clear. They are the disciplined corporate sniper. They can point to their unit economics and say, look, we have a clear path to break even by 2028. We aren't wasting your money on shiny consumer video generators. We serve Fortune 500 companies, and we will protect your capital.
Exactly.
But what is OpenAI's pitch? How do they justify asking the public to underwrite a $115 billion gap?
OpenAI's pitch relies entirely on scale and indispensability. They are arguing that they will become the central nervous system of the entire global digital economy.
Basically, you can't afford not to invest in us.
Right. The philosophy driving this was laid out very clearly by OpenAI CEO Sam Altman. In a post on X, he publicly justified the massive expenditure by stating, and I quote, "We believe the risk to OpenAI of not having enough computing power is more significant and more likely than the risk of having too much."
So if I'm trying to decode that, he is leaning into the cash burn. He isn't apologizing for projecting a $74 billion loss in a single year.
Not at all.
He is essentially arguing a philosophy of manifest destiny for compute power. He believes the world's appetite for artificial intelligence will be so all-consuming that it's mathematically impossible to overbuild data centers.
That's his bet.
The only real danger, in his eyes, is playing it safe, acting like Anthropic and suddenly realizing you don't have enough servers to power the world you just created.
That is the exact mechanism of his strategy. Altman is making a nearly $1 trillion bet that the company that physically owns the most compute will inevitably own the entire market. It's the ultimate build it and they will come strategy, but applied to physical infrastructure.
And Anthropic's counter bet.
Their counter bet is that agility and corporate trust will win. They believe you don't need to own every single data center to be immensely profitable. You just need your API to be indispensable to the businesses that keep the global economy running.
It's just a phenomenal clash of titans. We've covered incredible ground today unpacking this April 7 report. Let's kind of distill what this actually means.
Sure.
On one side, Anthropic is proving that you can build bleeding-edge AI while adhering to traditional business fundamentals. If you ruthlessly limit your scope to corporate clients and tightly control your cash burn to the tune of $22 billion.
Yep, a very focused approach.
On the other side, OpenAI is treating traditional business fundamentals as completely irrelevant to the AI revolution. They're betting that an omnipresent consumer-facing ecosystem requires an entirely new scale of financial gravity, securing $122 billion in private capital to just relentlessly buy up the world's compute bottleneck.
It perfectly captures the divergence as we hurtle toward these monumental Q4 IPOs. But before we step away, we really need to consider the one massive structural vulnerability in Sam Altman's grand strategy. It is the silent assumption holding up that historic $852 billion valuation.
Wait, what is the assumption?
Altman's entire $600 billion infrastructure plan relies completely on his belief in an insatiable demand for AI.
Right.
He is assuming that the exponential growth curve of user engagement, of everyday people wanting new AI features, will simply never flatten out. But what happens to the market, to the everyday investors who buy into that Q4 IPO, and to those staggering internal projections if that consumer appetite suddenly plateaus?
Oh, wow.
If the public decides they don't actually need a new photorealistic video generator every 6 months, and the demand slows down before OpenAI hits that magic 2030 break-even date,
The bottom falls out.
the entire financial engine powering that shiny luxury car doesn't just stall out. It could drag the entire tech ecosystem down with it.
That is a fascinating and, frankly, slightly terrifying perspective to leave off on. It completely shifts how you look at the technology we use every day. The real battle isn't just about who can write the smartest algorithm. It is about who has the sheer capital to survive the physical cost of running it. Thank you so much for joining us on this deep dive.
Thanks for having me. It was a great conversation.
And to you listening, keep questioning the numbers behind the narratives, keep looking under the hood of the tools you use, and we will catch you next time.
Keep connecting the dots.